We all want to make smart money
Right.
choices, but, sometimes it's like we're our own worst enemies when it comes to finances.
Yeah, it's really fascinating
It really is.
how our psychology can just kind of take over.
Yeah.
And we do things that in hindsight are just like, what was I thinking?
You have to,
Hmm.
ever wonder why you impulse bought those shoes or, panicked and sold everything during a market dip?
Oh,
That's exactly what we're diving into today.
it's so relatable.
The fascinating world of behavioral finance.
Yes.
We're going to unpack this insightful excerpt from What is Behavioral Finance?
Yes.
And hopefully uncover those kind of hidden forces that shape our money moves.
Yeah, I'm excited to dive into this.
Me too.
Yeah.
Are you ready to get a little meta
I am.
and analyze our own financial minds?
Absolutely. Let's debunk this myth of the rational investor.
Okay.
Traditional economics assumes we all make these calculated decisions
Right.
based on pure logic, but behavioral finance says that's not really the case.
Yeah, it's not like we're all just like Spock from Star Trek,
Yeah.
just evaluating risk and reward with pure logic.
Exactly.
I mean, if that were true, we wouldn't see people racking up credit card debt or selling off their entire portfolio during a market downturn.
Exactly. Emotions just take over sometimes.
They do.
And it's not a new phenomenon either.
Really?
This idea of financial irrationality has been around for over a century.
Wow. I had no idea it went back that far.
Yeah, George Selden, way back in 1912,
Wow.
published Psychology of the Stock Market.
Okay.
And basically was like, maybe our minds aren't these emotionless stock-picking machines.
Interesting. So that's where it all began.
That's kind of the seed of it.
Okay. But I guess things really took off with Kahneman and Tversky's work back in the 70s.
Oh, absolutely. Their research on these subjective reference points
Good.
was really groundbreaking.
Yeah.
They showed how our decisions are often based on, these arbitrary anchors
Uh-huh.
rather than objective logic.
It's almost like they were watching people make financial decisions and just being like, wait, you did what? No. That makes absolutely no sense.
Yeah, why are you doing that?
Totally.
And then Richard Thaler came along
Okay.
with mental accounting.
Mental account.
This idea that we kind of categorize money in our minds,
Okay.
even though it's all the same in the end.
Right.
Why do we budget our paychecks so meticulously,
Yeah.
but then splurge with our fun money or winnings?
Oh, that is so me.
Right.
I'm totally guilty of that.
It's like our brain just gives us a free pass
Totally a free pass.
to overspend if it's categorized as different money.
Yeah. Yeah, exactly. Different money. And it's like, okay, well, this is my fun money. So,
Yeah.
okay, well, speaking of mental quirks, let's talk about those cognitive biases.
Yes.
The sneaky mental shortcuts that can really trip us up financially.
The usual suspects.
Yeah, the usual suspects.
So what are some of the big ones we should be aware of?
Well, overconfidence is a huge one.
Overconfidence.
We tend to think we're better than average,
Okay.
whether it's driving intelligence or, picking stocks. It's that I totally got this mentality,
Exactly.
even when we haven't really done our homework.
Right.
I remember when I first started investing, I was so overconfident, I thought I could beat the market
Oh, yeah.
with all my amazing stock picks. Let's just say I learned that lesson the hard way.
We've all been there.
Yeah.
And then there's herd mentality, that urge to just follow the crowd,
Oh, yeah.
even when it's leading us straight into a financial pitfall.
Right, like all those meme stocks a couple years ago.
Oh, yeah. Perfect example.
Yeah, everyone's just piling in.
Yeah. Fueled by FOMO and social media.
Totally. And then,
Yeah. It's like a flock of birds.
exactly, just suddenly changing direction.
Everyone's just blindly following,
Yeah.
not even thinking for themselves.
And that can lead to asset bubbles and market crashes.
Oh, absolutely. Like the Silicon Valley Bank collapse.
Right?
That was a recent example where social media panic just triggered this mass withdrawal of funds.
Yeah, that was a wild
It's
situation.
a cautionary tale for sure.
Definitely. So overconfidence and herd mentality can lead us to some pretty risky moves.
For sure.
But what about loss aversion? That one really messes with our heads, doesn't it?
It does. That feeling of loss just hits us so much harder
Yeah.
than the joy of winning, even if the wins are bigger.
Yeah.
It can make us hold on to losing stocks for way too long.
Right.
Or sell winners prematurely out of fear
Yeah.
of losing those gains.
It's like clinging to a failing project or even a relationship
Right.
just to avoid that feeling of loss.
Exactly. We hate to admit defeat,
We do.
even when it's in our best interest to move on.
Yeah, totally. And I feel like confirmation bias is another big one,
Oh, huge.
where we just seek out information that confirms what we already believe.
Yes, even if those beliefs are flawed.
Yeah, it's like we're wearing those rose-colored glasses. We
Exactly.
just see what we want to see and ignore those warning signs.
It's like we're filtering out anything that doesn't fit our narrative.
Totally. So I guess being aware of these biases is like the first step.
Absolutely. Awareness is key.
Hmm.
The first step to overcoming them is recognizing their influence.
Right. So we've got overconfidence making us think we're financial geniuses.
Yes.
Herd mentality leading us to follow the crowd.
Uh-huh.
Loss version keeping us stuck in bad investments.
Yeah.
And confirmation bias blinding us to reality.
It's a wonder any of us make good financial decisions.
It really is, with all these biases working against us.
It's a constant battle.
It is. But don't worry.
But luckily, there are strategies
Okay, good.
we can use to outsmart these biases and make more rational choices.
Okay, so there's hope.
There is hope.
All right, well, we'll dive into those strategies in the next part of our deep dive.
Sounds good.
Welcome back to our deep dive into behavioral finance.
Glad to be back.
So we've met the cognitive bias crew.
Yeah, they can really wreak havoc.
They really can. So how do we outsmart them?
That's the million-dollar question.
It is, right? Like, we know about these biases now.
Right.
But how do we actually use this knowledge to make better financial decisions?
So knowledge is great,
Yeah.
but the real power comes from actually applying it.
Okay, so how do we go from awareness to action?
Well, one thing that can really help is self-awareness.
Okay, self-awareness.
Like really paying attention to your thoughts and emotions
Okay.
when you're making those financial decisions.
So like journaling.
Yeah, like keeping a financial journal.
Okay.
And I don't just mean tracking your spending,
Okay.
but like actually writing down how you're feeling.
So if I'm about to impulse buy that expensive gadget,
Yeah.
I should write down how I'm feeling, what's triggering that urge.
Exactly. Are you stressed? Are you trying to keep up with the Joneses?
Right.
Are you genuinely excited about the product itself?
Interesting. Okay, so writing it down helps you see those biases.
It can really help you analyze those motivations and
Yeah.
see those biases lurking beneath the surface.
Okay, so let's say I've identified my bias blind spots now. What?
Now comes the fun part.
Okay.
Figuring out how to actually break free from those patterns.
Right, because just knowing about them isn't enough.
Right, it's not a magic cure.
So what actually works?
Well, one powerful tool is pre-commitment.
Pre-commitment.
It's basically setting up systems or rules in advance
Okay.
so you don't have to rely on willpower alone when temptation strikes.
Ah, so it's like that saying failing to plan is planning to fail.
Exactly.
But in this case, it's more like planning to succeed by outsmarting my future irrational self.
Love that.
Right, because my future self is going to try to like sabotage me.
Oh.
So I got to like set some things in place now.
Exactly, like setting up those automatic transfers to your savings account each month.
Oh yeah, that's a good one
That way you're less likely to spend that money impulsively.
because it's already gone.
It's already earmarked for your goals.
That's a good one. What are some other pre-commitment strategies?
Sticking to a budget is another powerful one.
Budgeting.
Yeah, it's about making those conscious choices about where your money goes,
Right.
rather than just letting it slip away on things you don't really need.
I feel like I need to get better at budgeting.
It's a learning process, for sure.
So pre-commitment is about setting ourselves up for success
Exactly.
in advance.
Planning ahead.
Yeah. But what about when we're like right in the thick of it?
Yeah, those real-time decisions.
Yeah, about to make a decision. Are there things we can do in those moments?
Absolutely. Reframing is a great technique.
Reframing.
It's about shifting your perspective.
Okay.
Thinking about the situation in a different light.
So instead of fixating on the potential loss
Yeah.
of selling an underperforming stock,
Mm-hmm.
I could reframe it as freeing up capital to invest in something more promising.
Exactly. Or instead of viewing saving money as deprivation,
Yeah.
you can reframe it as investing in your future freedom.
Right. That's a much more motivating way to look at it.
Right. It's all about perspective.
It is. It's amazing how a simple shift in perspective
Yeah.
can like change everything.
Totally.
What about like taking a break?
Oh, yeah. The cooling off period.
Yeah, like if you're about to make a big purchase.
Exactly. Give yourself a day or two to think it over.
Avoid those impulse buys.
Those emotion-driven purchases.
Yeah.
Give your rational brain a chance to catch up.
I like that. What about budgeting apps?
Oh, those can be incredibly helpful.
Yeah.
They can provide that gentle nudge we all need sometimes.
Yeah.
To stay on track with our spending.
Right.
They can send you alerts when you're approaching your limits,
Okay.
or even help you visualize your progress towards your goals.
That's cool. It's like having a little financial guardian angel
I love that analogy.
right on your shoulder being like, Are you sure about that purchase? But
Exactly.
sometimes even with all these tools,
Yeah,
we need a little extra help.
they do.
So that's where a financial advisor comes in.
Exactly. A good advisor can provide that objective perspective,
Okay.
help you develop a personalized plan,
Right.
and hold you accountable to your goals.
Yeah, because sometimes we need that external accountability.
We do.
It's like having a financial coach in your corner. I like that.
Right, cheering you on and guiding you.
Absolutely.
But even if you don't have an advisor,
Yeah.
just talking to like a trusted friend or family member
Yeah, that can be really helpful.
about your financial goals.
It can provide support accountability.
Okay, so we've got a toolbox full of strategies.
We do.
Self-awareness journaling, pre-commitment, reframing, cooling off periods, budgeting apps,
Hitting all the highlights.
external guidance.
Yeah,
But, knowing these tools is one thing.
right.
Using them effectively is another.
Absolutely.
So what are some common mistakes that people make, even when they're trying to apply all these great principles?
Oh, there are a few big ones.
Okay.
One of the biggest pitfalls is trying to time the market.
Oh, yeah. Everyone wants to buy low, sell high.
The holy grail.
But it's like practically impossible to do consistently.
It's incredibly difficult.
Yeah.
Even for seasoned professionals.
So our emotions like fear and greed,
Yeah, they can really cloud our judgment.
yeah, and lead to bad timing. Exactly. We end up buying when the market's soaring
Right.
and selling when it's crashing, the exact opposite of what we should be doing.
The exact opposite. Okay, so what should we be doing?
Well, a long-term diversified investment strategy
Okay.
is generally a much more prudent approach.
So slow and steady wins the race.
Think of it like the tortoise and the hare.
I like that analogy.
Slow and steady often wins the race when it comes to investing.
So instead of trying to time the market perfectly,
Yeah,
which is like practically impossible,
pretty much.
we should focus on building a well-diversified portfolio
Exactly.
and riding out those market fluctuations.
Having a plan and sticking to it,
Okay, sticking to the plan.
rather than reacting emotionally to every little blip in the market,
Okay, so what's another common mistake?
chasing returns.
Oh, chasing returns.
We get lured in by the hype
Yeah.
of a hot stock or investment that's been doing really well.
It's like FOMO all over again.
It is, but past performance
Yeah.
is never a guarantee of future results.
Right.
Chasing returns often leads to buying high and selling low.
The opposite of what we want.
Exactly like trying to catch a falling knife.
Ouch.
Not a good strategy.
So how do we avoid that trap?
Well, discipline is definitely part of it,
Okay.
but it also comes back to having a solid investment plan
Okay.
and sticking to it no matter what the market's doing.
So having that plan is crucial.
It's like your financial roadmap.
Yeah, and not getting swayed by all the noise.
Tuning out the noise.
Okay, what other pitfalls should we be aware of?
Holding on to those losing investments for way too long.
I've been there.
It's that loss aversion bias we talked about.
Right, that sunk cost fallacy.
It's tough to admit defeat,
It is.
but sometimes the best move is to cut your losses and move on.
Easier said than done, I know.
It is, but those funds can be put to better use elsewhere.
So having that clear investment strategy is key.
It really helps you navigate all those psychological minefields.
Okay, so your plan should outline your financial goals, your risk tolerance, your investment strategy, and a plan for dealing with market fluctuations.
Exactly. It's like having that roadmap
Oh,
for your financial journey.
I like it. And don't be afraid to seek professional guidance.
Oh, absolutely. A financial advisor can be a huge asset.
Yeah, they can help create a plan that's tailored to your specific needs.
Exactly.
All right, so we've covered a lot of ground today,
We have.
talking about these sneaky biases
Yeah.
and how they can sabotage our best intentions.
But it's not all doom and gloom.
No, there's hope.
We've got tools and strategies to help us make smarter choices.
Okay, but before we move on, I have one more question.
Okay, sure.
We've talked a lot about how our emotions can lead to bad financial decisions.
Yeah.
But can our emotions ever be helpful?
That's a great question.
In this realm, can they actually guide us towards better choices?
You know what? Sometimes they can.
Really, I'm intrigued. Tell me more.
For example, our desire to provide for our loved ones.
Okay.
That can be a powerful motivator to save and invest wisely.
That makes sense, wanting to create a secure future for your family.
Exactly. And our sense of fairness
Right.
can lead us to support ethical companies
Right.
or invest in socially responsible funds.
So it's not about suppressing all of our emotions.
No.
It's about understanding them, harnessing them, and
Exactly.
using them to our advantage.
Finding that sweet spot where our emotions and our rational minds can work together
I like that.
to achieve those financial goals.
This has been so eye-opening. I feel like I have a whole new understanding of my own financial psychology.
It's amazing what a little self-reflection can do.
But before we wrap things up, I want to hear some real-world examples
Yeah, let's bring it to life.
of these behavioral finance concepts in action.
Perfect. So in the final part of our deep dive,
Okay.
we'll explore some fascinating case studies that really illustrate these principles.
Welcome back to the deep dive. We've been uncovering these sneaky cognitive biases that can sabotage our financial decisions.
Yeah, and we've learned some strategies to outsmart those biases.
Okay.
But now it's time for the fun part.
Yes, the real-world examples.
Exactly.
What have you got for us?
Well, let's start with anchoring.
Anchoring.
Remember how we talked about a salesperson throwing out a ridiculously high price at the beginning of a negotiation?
Right, they set that high anchor so any lower price seems like a great deal, even if it's still overpriced.
Exactly. Well, there's this classic experiment that shows this concept perfectly.
Okay, I'm listening.
Researchers asked people to write down the last 2 digits of their social security numbers.
Their social security numbers. What does that have to do with anything?
That's the point. It's totally random information, but then they asked these same people to bid on a bottle of wine.
Okay, now I'm really curious what happened.
The people with higher social security numbers ended up bidding way more for the wine.
No way, are you serious?
Totally, even though those digits had absolutely nothing to do with the wine.
Wow, so they became an anchor.
An anchor that unconsciously swayed their bidding.
It's kind of scary how easily our brains can be tricked.
It really is.
Okay, what other real-world examples do you have?
Let's talk about herd mentality.
Herd mentality.
Remember those dangers of blindly following the crowd?
Oh yeah, especially in the financial markets,
Like those asset bubbles and market crashes.
where everyone's piling into an investment without really understanding the risks.
The dot-com bubble of the late 90s is a perfect example.
Oh yeah, everyone thought internet companies were the future.
Everyone was pouring money into them,
It was like a digital gold rush.
fueled by hype and speculation,
And then the bubble burst.
and a lot of people lost a lot of money.
It's a harsh lesson in the dangers of herd mentality.
So it's important to do your own research.
And think critically.
Don't let FOMO cloud your judgment.
Okay, what about loss aversion?
Loss aversion. This one's a biggie.
It can really mess with our heads.
There's an experiment called the framing effect that illustrates this perfectly.
Framing effect, I've never heard of that.
Researchers gave people 2 options for dealing with a hypothetical disease outbreak.
Okay, I'm intrigued.
Option A was framed in terms of lives saved. 200 people will be saved.
Okay.
Option B was framed in terms of lives lost, a 1/3 probability that 600 people will be saved, and a 2/3 probability that no one will be saved.
So both options have the same outcome, right?
Exactly the same expected outcome.
Yeah.
People were way more likely to choose option A,
The one framed in terms of lives saved.
even though the options were logically equivalent.
Wow, so the way it was framed really mattered.
It shows how loss aversion can skew our decisions,
We're wired to avoid losses.
more than we're driven to achieve gains.
It's a good reminder to try to evaluate options objectively.
Strip away that emotional layer.
Okay, one last case study.
Let's talk about overconfidence.
Overconfidence, thinking we can beat the odds.
There's this thing called the planning fallacy.
Planning fallacy? What's that?
It's that tendency to underestimate how long it'll take us to complete something.
Oh, I do that all the time.
We all do it. We're overly optimistic,
And then reality hits.
driven by overconfidence.
So how do we overcome this planning fallacy?
Break down tasks into smaller chunks.
Okay.
Set realistic deadlines.
Yeah.
Build in some buffer time.
For unexpected delays.
And don't be afraid to adjust your plans as needed.
Be flexible.
Exactly.
These case studies have been really fascinating.
They really show these biases in action
They do.
and how they can impact our decisions.
So what's the key takeaway?
We're all human.
Yeah,
We all make irrational decisions.
sometimes.
But by understanding these forces,
Yeah,
we can make more informed choices.
it's about being mindful
Self-aware.
and having a plan.
Exactly.
This has been such an insightful deep dive.
Been a pleasure.
I feel like I've learned so much about myself and my own financial decision-making.
That's what it's all about.
Well, that's all for this episode of The Deep Dive.
Thanks for listening.
We hope you enjoyed this exploration of behavioral finance and that you'll join us again next time for another deep dive into a fascinating topic.